Gold prices have surged to record highs many times this year. So from your perspective, what is the primary force behind this round of sharp rally? Is that safe haven demand, monetary expectations, or just simple speculative positioning?
I think it's a combination of all of it. And what you have to do is distinguish the objective and the subjective. So when we try to analyze whether interest rates are going to affect something or these fundamental factors, there are so many factors to look at. And each person and each analyst will subjectively choose what they want to put more emphasis on. I try to look at, I say, okay, here's the situation. How did the price react to that? And it might tell me that quite often, if there are projections when you're listening to the media or pundits about what the Fed is going to do, quite often the market has already priced that in. And I think that happened to some degree here. And that's the way I look at it. And so the market acted very bullishly. The thing about gold, and this has happened since 2003, the driver of gold is investment demand. And now you've got a little bit of there's a significant other factor. You see central bank buying that's come in too, but it's still ultimately investor demand that drives the price of gold.
Both gold and silver are hitting record levels, and the gold to silver ratio has fallen back to around 80. So does this indicate a broad-based bull market in precious metals? And how do you interpret this divergence between the two?
The gold-silver ratio is interesting. And what's interesting to me is the emphasis that a lot of people put on it. Since gold and silver are two fundamentally different markets, gold is more, as we talked about, a store of value. Silver has more of an industrial use, primarily industrial use. That's its function. It does have, obviously, the precious metals component to it, and often they call it the poor man's gold. But back in 1980, the ratio went from about 40 down to 17. And the reason that it went down to 17 is because silver had a squeeze at that time. The Hunt brothers, back in 1979, 1980, along with some of the Middle Easterners, tried to corner the gold or the silver market. So silver went up to $50. Silver previously, the previous highs were all the way back then. So where gold went up to $850. So when we take a look at it, I think one of the reasons that the ratios have changed so much is because the higher the prices go, it's going to change that ratio. I don't like to trade that ratio, but I do pay attention to it because other people do. So you may think that you may see some buying or selling in one market or another based on that, but to me, that's more short term. I think fundamentally and from a price structure basis, you have to look at each market individually.
This year, gold is up about 60%, outpacing most asset classes. So do you believe the market has already fully priced in potential Federal Reserve rate cuts, or could investors be overestimating policy easing?
Yeah, I don't think that they overestimated, but what happens is, what I believe is that because of access to the market, that it's so easy to access these markets, and quite often people look at these the same stimuli, and everybody's hitting the same button at the same time when they see something. So that's where you see overreaches in the market. So underestimating it on a fundamental thing, they may be correct. But if everybody is doing the same thing, it's always going to be either overbought or oversold, depending on but the market will eventually go back to its fair value.
With the US government shutdown standoff deepening and Treasury credit concerns rising, could physical instability itself become a medium-term structural driver for gold?
It could, but again, that would be a subjective actions rather than objective, because it's very difficult to measure that. It depends where your bias lies and what you think. I think that this shutdown, we've had shutdowns before. I think this one's going to be resolved quickly. Being a bit cynical politically on it, I think that part of it was by design to try to get more voter registrations coming in. We have elections coming up in November for mainly local elections, and you'll see some some things. The midterms will be next year, which will be more important. But I think they're trying to get more voter registrations by getting one side or the other enthused about it. So we'll probably see. You're seeing some important races in, say, Virginia and New Jersey, that there are very tightly contested races that are quite important for governors and attorneys general and things like that.
Central banks have been major buyers amid the global de-dollarization trend. So how significant is this factor in supporting gold's rally? And do you think this narrative might be exaggerated by the market?
Well, one of the things that you have to realize is that gold is priced in dollars. So as a dollar weakens, it's going to take more dollars to buy gold, so gold's going to be more expensive. And if you look at gold in terms of other currencies, you might see a little bit of a different picture. However, to your point, we've been looking at de-dollarization ambitions for quite a while. The thing is, right now there are so many dollars out in the world. I don't think right now it's going to take a long time for that to run through the market before you find a replacement. However, people are losing trust in fiat currencies, no matter what it is. And so they're going more to hard assets. Gold is one of them. You see people going into crypto, which is another story, but they're trying to find alternatives to holding dollars. And so I think regardless, even if the dollar rebounds, I still think there's going to be demand for gold because there's a large sentiment out there, and gold has now become more in favor, which is quite different than it was if you go back to year 2000 or so, before 9/11. Gold was out of favor. Nobody wanted it. Even the central banks at that time were selling gold, and they had a thing called the Washington Agreement that restricted how much the banks could sell. So central banks they're still not the major force behind this. It's still investor demand. And a good proxy for investor demands is looking at ETF inflows and outflows.
Some analysts warn that the gold trade is becoming overcrowded, leaving it vulnerable to sharp pullbacks once dollar liquidity tightens. So do you share this same concern? And what early warning signs could you be watching for?
Well, one of the things you do is you can listen to the news and you can look at market sentiment. And if everyone is bullish, quite often if you put a contrarian hat on, that shows you that you might be looking. You take a look at the same thing in gold. Everybody's talking about gold. If you look at podcasts, if you look at the news, every other commercial is somebody trying to sell you gold. Like I said, the supply of gold isn't as significant as the demand. So the strength of demand is what determines the price. And if something gets overbought or oversold, you're going to see the market correct. And that's where we're in the phase of right now, starting today. So we'll see what levels it corrects down to.
Historically, during periods of U.S. liquidity stress, such as 2008, 2013, or 2023, gold prices have briefly fallen before rebounding. So do you see similar liquidity risk emerging now?
Well, one of the interesting things about gold, and the reason that I think it does this, when you see it, it just happened recently too, where gold came down when the stock market came way down, is because in 2003, gold became securitized because of the advent of ETFs. So you had a whole asset class that was now accessible to asset managers, where before they were precluded from including commodities. So if you take a look at where gold was in 2003, that was a real start of bringing more and more investors into gold. And that changed the dynamic where the investor demand is driving it. So we're seeing the same thing now. So what happens? If gold is a security and you have that with the rest of your stocks, and then you have a drop in the stock market and people are getting margin calls and things like that, they need to sell things in their portfolio, including the gold ETFs, which would put pressure on the gold price. So as the stocks go down, even though they're normally not correlated, there's a liquidation in gold, and then gold will come back. But they're being liquidated for those panic reasons that the whole equity market has.
Do you see the potential for prices to break through 4,500 or even 5,000 And under what macro conditions could that happen?
Well, from a fundamental macroeconomic thing, the U.S. is sitting on $35 trillion public debt. That has to have some effect, and it's gone up dramatically. You talk about a parabolic move. We've seen a parabolic move in government debt, and at some point, as I said, you want to move out of fiat currency. So I think the demand for gold and the case for gold is going to be there for quite a while. I can see gold, and I hate to predict prices. I'll try to look at the price structure and maybe find some measuring objective, but it could have another, after it settles down a little bit here and then sets another, creates another base. It could go up to $5,000, $6,000, $7,000. But it could also come down significantly depending on on how things happen. But we see, for instance, like you take a look at it looks like the Middle East might be settling down a little bit. So you've seen a lot of pressure on oil. Oil's under $60 now. It's trading around $57 in the U.S. right now, and everybody was thinking oil was going to 150 or something like that. So the markets are fickle. The news travels very fast, and so you're going to see swings in the market. But fundamentally, I think for the next few years, gold is going to remain I'd have to be bullish on gold for the next few years.